The two biggest payment companies in the world just introduced the technology that finally gives cryptocurrency a truly essential use case, and almost no one is paying attention. Stripe and Coinbase have both launched systems that let autonomous AI agents pay for things instantly using stablecoins, and this all happens without needing a human's credit card or bank account. Now, the reason this is happening is simple, and it's a huge problem for the old school financial system. These smart agents physically can't use traditional systems like Visa. They can't follow Know Your Customer or KYC rules, and they can't wait 3 days for a bank transfer, which is ACH, to go through. Plus, the amount of business that these agents will handle is going to be massive. Citi Ventures estimates that by 2030, this agent-driven commerce could be worth $1.7 trillion. McKinsey suggests that retail sales managed by these agents could be between 3 and 5 trillion. And Bain thinks AI agents will complete up to a quarter of all US online shopping in that same time frame. And the groundwork for this massive change is being laid right now, in the open, by the world's biggest payment companies. But only a few specific technologies will win. And the risk that all of this power will end up in just a few hands should seriously worry everyone. My name is Lewis, and you're watching the Coin Bureau. To understand why this is happening, you first need to look at the main problem the entire AI industry has been struggling with for the past year and a half. Every demonstration from companies like OpenAI, Anthropic, and Google that promise an AI agent will act for you instead of just chatting with you hits a wall the moment that agent needs to spend money. Credit card companies charge a minimum fee of 30 cents per transaction. This makes it all but impossible to make small or so-called micro payments. Bank transfers, meanwhile, can take 2 to 3 days, which makes real-time payments for agents completely unfeasible. Chargeback rules that were created for when a human disputes a fraudulent charge break down completely when the buyer is a piece of software with no legal standing. And of course, KYC and anti-money laundering measures assume that a human is involved, one with a passport and a home address, neither of which an autonomous program can provide. Now, think about what an agent actually needs to do. It might pay for a fraction of a cent for a single piece of data, like an API call, then argue with another agent over the price of a large set of data, then book and rebook a flight 4 times in an hour as prices change, and finally settle a tiny payment to a content creator. This could happen in a continuous loop thousands of times a day. There is no version of the current financial system that could handle this workload, and the people building these agents have known this for a while. Simply put, the solution was never going to come from the old school banking world. It was always going to come from a payment system that can be programmed easily, was tied to the US dollar, and didn't care whether the entity making the transaction was a human or a computer program. And this leads us to a new system that the world's most important payment companies have just started using. In late 2025, Coinbase officially brought back a long-forgotten part of the internet's original design by activating the HTTP 402 status code. This is the payment required response that was first planned in 1991, but was never actually widely used. The new system is called X402, and the way it works is truly revolutionary. When an agent asks for something from a website or a digital service, the server can reply with a 402 status message that includes payment instructions right in the response. The agent then quickly signs a stablecoin transaction, sends the same request again with a payment confirmation attached, and instantly receives what it asked for. No need to create an account, no monthly bills, no human approval needed, and no monthly invoice balancing. It's just programmable money moving through the same basic system that already powers the entire internet. And what makes this a serious, real-world change, not just another experimental crypto project, is the most powerful companies in the world that are supporting it. The system is now managed by the X402 Foundation, which is part of the Lunix Foundation, the same neutral group that manages core internet standards. The list of companies using it includes Google, Stripe, Amazon Web Services, Cloudflare, the Solana Foundation, and surprisingly, Visa and MasterCard themselves, the very companies this new system is set to disrupt. The Coinbase Developer Program now offers a service that handles X402 payments, supporting major networks like Base, Solana, Polygon, and others. It has a free option for 1,000 transactions a month, and after that, the fee is 1/10 of a cent per transaction. To compare, the cheapest credit card transaction in the old system cost roughly 300 times more. And that's before you consider costs for chargebacks, network fees, and the money that banks must keep in reserve. Stripe has done something similar with its machine payments protocol, launched in March of this year with Tempo Labs. And Visa is even involved as a key validator on the underlying blockchain. The Stripe version allows for payments using both stablecoins and traditional money through pre-funded accounts and large off-chain settlements. It is fully built into Stripe's current services, including tax handling, fraud protection, and refunds. The fact that the two largest payment infrastructure companies in the world are both building similar, though slightly different, machine payment standards at the same time proves that this is not a small-time experiment. It's a fundamental shift in the structure of payments. Meanwhile, the hard numbers of X402 usage are public and clearly show where things are heading. The system has processed between 75 million and 167 million transactions in the last 30 days, depending on the source, with total money settled across the $50 million mark. About 9 out of every $10 flowing through X402 settled on Base, Coinbase's Layer 2 network. Meanwhile, Solana handles the majority of the number of transactions because it can confirm payments in under a second and its fees are less than a cent. Now, a critical reality check is that the total amount of money settled each day in late March was still only about $28,000. This tells you that the sector is still building the underlying technology rather than seeing massive public use yet. But the same was true for secure web browsing, HTTPS, in 1996, and the Internet's core communication protocol, TCP and IP, in 1985. The question is never whether the technology will grow, but who will benefit from it when it does. Now, the speed at which all of this is moving makes it really hard to follow through regular financial news, which is mostly still trying to explain what stablecoins even are. So, if you want to track this in real time, the new partnerships, the shifts in transaction volume, the new rules, and which specific systems are actually being used by agents, then you could get all of that and more at the Coin Bureau Telegram channel. That is where we post our analysis the moment major news happens, share the actual data that we're tracking, and flag these structural changes before the wider market realizes what's happening. The link is in the description below, and it's completely free. And given how fast that this area is moving, it's definitely worth it to stay informed. Now, back to the matter at hand. The simple way to think about this is that AI agents are good for crypto, so the entire crypto market will benefit. This, though, is the same rising tides lifts all boats idea that has been wrong during every major adoption cycle before this. The real impact is much narrower, and the price movements in the markets are already showing you exactly which assets are capturing the value. For example, Bitcoin doesn't have a built-in way to handle stablecoins. Its fee structure is wrong for payments under a penny, and it takes tens of minutes to finalize a transaction instead of a fraction of a second. Ethereum's main network fees are also too high, which completely prevents it from being used for agent-scale micropayments. So, the networks that should genuinely benefit are the ones with the technical features that agents absolutely require, and the data is very clear here. Solana processed 25.3 billion transactions in the first 3 months of this year alone. The total monthly stablecoin volume on the network passed Ethereum's at $650 billion in February. And Circle minted over $10 billion in new USDC on Solana in a single recent month just to keep up with demand. The average time people hold a stablecoin on Solana has dropped dramatically, from around 29 hours to roughly 70 seconds over the last 2 years, a speed that no other major network comes close to. That said, Solana's price has struggled this year, suggesting that the market has not yet begun to fully value the idea of AI agents using it for transactions. Tron, meanwhile, holds the most raw stablecoin value, hosting around $47 billion in USDT supply with over $2 trillion in transfer volume across the first quarter. And then there's Base, which captures the vast majority of the dollar volume on the X402 system, because it is so tightly linked to Coinbase's development tools, agent kit, and the broader Coinbase ecosystem, making it perhaps the most agent-friendly environment currently running. Now though, we get to the part of the story that is both the strong argument for growth and a serious warning about centralization. If autonomous agents are settling their payments in stablecoins, then USDT and USDC issuers, Tether and Circle, effectively become the central banks of the machine economy, and the potential value for both companies is astonishing. Tether currently has $187 billion in USDT supply, with $89 billion in trading volume over 24 hours. The company has made over $10 billion in profit last year, with the staff measuring in only the hundreds. Its reserves include roughly $122 billion in direct holdings of US Treasury bills, with total US government debt exposure of about $141 billion. This places a single private company amongst the largest holders of American government debt anywhere in the world. Circle, meanwhile, has about $76 billion in USDC supply. It went public in June of last year at $31 a share, briefly traded as high as $299, and now sits at roughly $100 with a market value of $26 billion after a tough period following the IPO. The combined daily trading volume for both stablecoins now exceeds $139 billion. Monthly stablecoin transfer volume passed that of the entire US bank transfer network for the first time in February of this year at $7.2 trillion, and the total supply of stablecoins industry-wide has crossed $315 billion. But here's the big problem that the positive outlook completely ignores. Both USDT and USDC have administrative blacklist functions written directly into their code. This allows the issuer, Tether or Circle, to freeze any wallet on the network instantly, with no court order, no legal review, and no due process whatsoever. This is not just a theoretical danger from an academic paper. It is an operating reality that was demonstrated just days before this video was even recorded. On April 23rd, Tether blacklisted 2 addresses on the Tron network and froze $344 million worth of USDT in a single action coordinated with the United States Office of Foreign Assets Control, or OFAC. Treasury Secretary Scott Bessent publicly confirmed the freeze the next day as part of an action against groups linked to the Iranian Revolutionary Guard Corps. Blockchain forensic companies confirmed the wallets belong to entities including the Central Bank of Iran and Hezbollah funding channels. That single action is the largest stablecoin enforcement event in the history of the asset class. The total amount Tether has frozen throughout its operations now exceeds $4.4 billion across more than 2,300 individual cases, coordinated with 340 law enforcement agencies in 65 countries. The Financial Action Task Force made this official in March by clearly recommending that countries require stablecoin issuers to maintain the ability to freeze, destroy, and deny lists at the code level. This means the ability to instantly shut down a wallet is no longer a business choice, it's a government requirement. And of course, we should absolutely trust to private companies with the unchecked power to freeze any agent's transaction anywhere in the world to use that power carefully and fairly, especially given how perfectly the traditional banking sector has managed similar powers historically. And this presents a big potential stumbling block for the AI agent economy.
Right, if you're looking to trade these latest market moves, whether that's crypto or traditional assets like gold and commodities, then BitGet is definitely worth a look. They've just rolled out their TradFi trading platform, which lets you trade assets like gold and other commodities directly using USDT, so you don't need to jump between platforms. You also get deep liquidity, low slippage, and access to up to 500x leverage. Now, if you sign up using the QR code on screen or the link in the description, you can get up to $50,000 in bonuses. And on top of that, if you complete your first net deposit of $5,000 and place your first trade, you'll unlock a VIP 3 trial. Now that includes up to 38% fee discounts, exclusive VIP perks, and free token airdrops. So scan the QR code, check the link below, and see what BitGet has to offer.
If your agent is in the middle of booking a flight, negotiating a contract, or rebalancing your money, and the wallet it uses is flagged, correctly or incorrectly, the entire operation instantly freezes with no way to appeal and no human capable of stepping in before the cascading failure destroys the transaction. So, the most open and permissionless payment network ever created is being built on top of the 2 most restricted and controlled assets in the entire crypto ecosystem. And that contradiction could end up being a regular bone of contention as the machine economy evolves. And this brings us directly to the deepest consequence, the one that almost no one in the AI or crypto industries is talking about openly. As autonomous agents take over more of your daily economic life, paying your subscriptions, negotiating your bills, booking your travel, and investing your extra money, you stop being a participant in your own financial life and start being an auditor of monthly summaries. Forrester already predicts that human visits to bank websites will drop by 20% by the end of this year, while traffic started by machines will surge by 40% in the same period. This means that humans are already on track to become a minority user class of the very system that holds their wealth. The chain of events here goes far beyond anything fintech ever delivered. Fintech still shows you every individual transaction in an app, but the agent layer removes the transaction itself from your view entirely. You no longer see the half-cent paid for an API call, the negotiated discount on your insurance renewal, or the rebooked flight that saved you $40. You only see the final result at the end of the month. The framework that the academic Shoshana Zuboff developed around surveillance capitalism applies almost perfectly here. The trail of behavioral data created by thousands of autonomous agent decisions made on your behalf becomes far more valuable to the platforms running those agents than the transactions themselves ever were. The code that optimizes the agent's decisions is written by someone. The choices about which payment route to take favor someone, and the platforms collecting the data answer to someone. And in almost every case, that someone is not you. So here's the honest look at where we actually stand. Crypto spent the better part of a decade looking for a breakthrough use that everyday people genuinely cared about. Payments never really took off. NFTs faded, DeFi remains a niche plagued by hacks and exploits, and the whole story just kept on changing with whichever speculative trend could attract new retail money. Perhaps the breakthrough use was never going to come from convincing humans to stop using Visa. Perhaps it was always going to come from a new type of economic actor that couldn't use Visa in the first place, and, well, autonomous agents are that actor. The infrastructure is being put together right now by the largest payment companies on Earth, in full public view. The winners are very few. The value concentrates around stablecoin issuers and a handful of high-speed networks, and the rest of the crypto market is largely just looking on, no matter what the dominant narrative claims. The long-term question worth thinking about, the one that truly matters before the answer is decided for us by whatever combination of regulators and platforms moves fastest, is what happens to our control over our own lives when our money starts moving without our input. But we want to know what you think. Will the agent-driven economy unlock a genuine rebirth of programmable commerce that lets individuals take back time and money from the traditional financial system? Or are we building the most efficient system for surveillance and extracting value in human history, all under the friendly label of automation and convenience? Let me know your thoughts in the comments down below. And if you want to understand exactly how the Genius Act and the broader regulatory boundary being built around stablecoin issuers will shape every single one of these trends basically through the rest of the decade, then you could check out our full deep dive on that legislation right over here. Thank you all so much for watching, and I'll see you again very soon. This is Lewis, signing off.